What if I told you that you could become a millionaire by investing just $500 a month? No inheritance, no six-figure salary, no lucky stock picks, just $500 invested consistently, using a strategy so simple that a 12-year-old could follow it. Most people hear the word millionaire, and they think it is impossible for them. They think you need to earn a massive income or have some kind of special financial knowledge. But here is the truth that Wall Street does not want you to know. Becoming a millionaire is a math problem. And today, I am going to show you exactly how that math works. Before we get into the strategy, let me share a number that should change how you think about wealth forever. According to a study by Ramsey Solutions, 79% of millionaires in America did not receive any inheritance at all. Not a single dollar from their parents. They built their wealth through consistent investing over time. The same strategy I am about to show you. So, if you have ever thought that wealth is only for people who were born into it, that belief ends right now. Step 1. Know exactly where to put your money. This is where most people get paralyzed. They think they need to research hundreds of stocks, follow market news daily, or hire an expensive financial advisor. You do not. The single best investment for the vast majority of people is an S&P 500 index fund. Ticker symbols like VO from Vanguard or SPY from State Street. Here is why. The S&P 500 tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Tesla, and 495 others. When you buy one share of an S&P 500 index fund, you are automatically diversified across all of them, and the historical average annual return of the S&P 500 is approximately 10% per year. Not every year, of course. Some years it is up 30%. Some years it is down 20%. But over any 20-year rolling period in the entire history of the stock market, the S&P 500 has never lost money. Never. Not through the dot-com crash, not through the 2008 financial crisis, not through COVID. If you held for 20 years, you made money, every single time. Warren Buffett himself has said that for 90% of people, a low-cost index fund is the best investment they can make. And his fees? Nearly zero. Vanguard's VOO charges just 0.03% annually. Compare that to actively managed funds that charge 1 to 2% and still underperform the index 90% of the time. Now let me show you the math, because this is where it gets exciting. If you invest $500 per month at a 10% average annual return, here is what happens. After 5 years, you have roughly $40,000. Not bad, but not life-changing. After 10 years, you have approximately $102,000. Now things are getting interesting. After 15 years, you have about $208,000. After 20 years, you have $380,000. And after 25 years, you cross the $1 million mark with approximately $1.1 million. But here's the part that really shows the power of compound interest. Out of that $1.1 million, you only contributed $150,000 of your own money. $500 times 12 months times 25 years equals $150,000. The remaining $950,000 was generated entirely by compound interest. Your money made money, and then that money made more money. And that process repeated thousands of times over 25 years. This is not speculation. This is not theory. This is math based on historical market returns. Step 2. Use tax-advantaged accounts to accelerate your wealth. This is where smart investors get an unfair advantage. Instead of investing in a regular brokerage account where you pay taxes on your gains every year, use accounts designed specifically to grow your wealth tax-free. The Roth IRA is the most powerful wealth-building tool available to most Americans. You contribute after-tax dollars, your investments grow completely tax-free, and when you withdraw in retirement, you pay zero taxes. Nothing. The current annual contribution limit is $7,000 per year, which works out to about $583 per month, almost exactly our target number. If your employer offers a 401k, especially with a company match, that is free money. If your company matches 50% of your contributions up to 6% of your salary, and you are not contributing at least 6%, you are literally leaving free money on the table. The HSA, or health savings account, is the secret weapon that most people overlook. It is triple tax advantaged. You do not pay taxes when you put money in. You do not pay taxes while it grows. And you do not pay taxes when you take it out for qualified medical expenses. No other account in existence has all three benefits. Step 3. Automate everything and do not touch it. This is the most important step, and the one that separates people who actually build wealth from people who just talk about it. Set up automatic contributions to your Roth IRA or brokerage account on the same day your paycheck hits. Whether that is the first of the month, the 15th, or every 2 weeks, make it automatic, make it consistent. And then here is the hard part. Do nothing. Do not check your portfolio every day. Do not panic when the market drops. Do not try to time when to buy or sell. The data is crystal clear on this. Time in the market beats timing the market every single time. A study by Fidelity found that the best performing accounts in their system belonged to people who had either forgotten they had an account or were literally deceased. That is not a joke. The people who did absolutely nothing after investing outperformed the active traders, the market timers, and the professional fund managers. Set it and forget it is not lazy. It is the most disciplined and effective strategy that exists. Now, I know some of you are thinking, I do not have $500 a month to invest. I hear you. So let us talk about how to find that money. First, audit your subscriptions. The average American spends over $200 a month on subscriptions they rarely use. Netflix, Spotify, gym memberships, streaming services, software subscriptions, app subscriptions. Cancel everything you have not used in the last 30 days. Second, look at your food spending. The average American household spends over $600 a month on dining out. You do not need to stop eating out entirely, but cutting that in half gives you $300 right there. Third, apply the 50-30-20 rule from our previous video. 50% of your income to needs, 30% to wants, 20% to savings and investments. If you earn $3,000 after tax, 20% is $600. More than enough for our $500 target. The money is there, you just need to redirect it. Now let me tell you about the 3 biggest mistakes that destroy people's chances of building wealth. Mistake number 1. Trying to time the market. People wait for the perfect moment to invest. They think, the market is too high right now, I will wait for a dip. Here is the problem. Nobody can consistently predict when dips will happen. A study by Charles Schwab showed that even if you invested at the absolute worst time every single year, meaning you bought at the market's peak each year, you would still end up with more money than someone who kept their cash on the sidelines waiting for the perfect entry point. Time in the market always beats timing the market. Mistake number 2, panic selling during downturns. When the market dropped 40% during COVID in March 2020, millions of people sold their investments in fear. By the end of that same year, the market had fully recovered and hit new all-time highs. Those who sold locked in their losses. Those who held or bought more during the dip made a fortune. Every market crash in history has been followed by a recovery. Every single one. Mistake number 3, paying high fees. A 1% management fee might sound small, but over 30 years, it can eat up to 30% of your total returns. That is hundreds of thousands of dollars lost to fees. Use low-cost index funds with expense ratios below 0.1%. Your future self will thank you. Let me show you one final comparison that puts everything into perspective. Person A starts investing $500 per month at age 25 and stops at age 35. They invested for just 10 years, $60,000 total. Then they let it grow without adding another penny. Person B waits until age 35 and invests $500 per month for 30 years straight until age 65. They invested $180,000 total, 3 times more than Person A. At age 65 with a 10% average return, Person A has approximately $1.7 million. Person B has approximately $1.1 million. Person A invested less money for fewer years and still ended up with $600,000 more. That is the power of starting early. That is compound interest working in your favor. Every year you delay is the most expensive decision you will ever make. Here is your action plan. This week, Not someday, not eventually this week. Do these 3 things. 1. Open a Roth IRA at Vanguard, Fidelity, or Charles Schwab. It takes 15 minutes. 2. Set up an automatic monthly transfer of $500, or whatever you can afford right now, into an S&P 500 index fund. 3. Delete your trading apps. You do not need them. Stop checking the market daily. Let compound interest do what it has done for over a century. If this breakdown helped you see that becoming a millionaire is not about luck, but about math and discipline,